The last scenario is collapse, which I actually think is the most likely. Through a combination of wishful thinking, denial, delay, we'll probably just blunder into a collapse, at which point the response would take the form of executive orders and, if there's social unrest, probably some kind of neo-fascism. There's good reason to believe that we are looking at a potential collapse of confidence in the U.S. dollar and indeed the entire international monetary system. The international monetary system is based on the dollar, so if the dollar goes, the system goes. That's not meant to be a provocative statement. The international monetary system has actually collapsed 3 times in the past 100 years, in 1914, 1939, and 1971. So this would be the 4th collapse in 100 years, so not that infrequent. And when the monetary system collapses, it's not the end of the world. We don't all go live in caves and do canned goods and all that. What happens is the major trading and financial powers get together, they sit down, and they recut the deal, what's called the rules of the game. So what I want to think about a little bit is, since we can see the collapse coming, is what are the new rules of the game? What would the international monetary system of the future look like as a result of a sort of a new Bretton Woods-style conference in the face of a collapse? And I've got 4 scenarios here: multiple reserve currencies, SDRs, gold, and collapse, followed by something worse. Multiple reserve currencies, the idea is, in 2000, 70% of international reserves were held in dollars. Today, that number is 60%. It's trending down. So imagine a world where the dollar goes below 50%. Maybe it's 45 or 40%. The euro comes up. The Australian dollar and Canadian dollar were just recently admitted by the IMF as official reserve currencies, so they have a larger role. And we end up in the situation where, you get a whole bunch of reserve currencies. I call it the kumbaya solution. We all just get along. This won't work. This is unstable because there is no anchor. There's no gold. There's no dollar. So instead of one central bank behaving badly, you'd have 5 or 6 or 7 behaving badly. I think this would exacerbate rather than mitigate the currency wars. The next one, this is the one preferred by the elites. When I say elites, it's not a deep, dark conspiracy. Finance ministers, treasury secretaries, academics, central bankers, other policymakers. This is the SDR. The SDR is a special drawing right. It's understood by very few people, but it's unbelievably simple. The way to understand it, the Fed has a printing press. They can print dollars. The European Central Bank has a printing press. They can print euros. And the IMF has a printing press. They can print SDRs. And that's all it is. It's world money. They can print as much as they want. They hand it out. They can reflate and reliquefy the global economy. The IMF actually has a 10-year plan to make the SDR the global reserve currency. Again, not a secret. You can find it on their website. I want to give a quick example because I know this is attuned to policy, but how the SDR is already sort of creeping into our system. The United States Treasury got authority to provide $100 billion to the IMF. This was legislation passed in 2009. So what did the IMF do with the money? Well, what they did is they, if you look at the total IMF loans, credit lines, etc., 91% of all the IMF loans and advances, they went to bail out Europe or to Mexico. Only 9% went to the rest of the world. I leave it to you to decide whether the president was entirely candid with the Congress when he said this is primarily for developing and emerging market economies. You don't see Korea, Indonesia, India, Brazil, Thailand, Malaysia. You don't see those countries getting more than 9% of the IMF money. This money basically went to bail out Europe. So that's another thing where, again, I think the American people were a little more aware. They might raise a few questions. Third outcome is the gold standard. I'm just going to go through this very quickly. All gold standards are a relation between paper money and gold. But you have to ask yourself a couple questions when you set up a gold standard. First one is, what's your definition of money? Because we have M0, M1, M2. These are technical definitions. They're all different. So you have to pick one of those to be your money. The second one is, what's the proper reserve ratio? Do you need 100 cents on the dollar of gold to back all the paper money? Well, a lot of gold bugs would say yes. But historically, that's not true. England ran a very successful gold standard in the 19th century with 20% backing. The United States, through most of the 20th century, was on a gold standard with 40% backing. So history says you can have 20 or 40% backing, and that works just fine. Third thing is which nations are included. The simplest way to understand that, the U.S. could do this on its own, but it would be a blunder, because if we had a gold standard, a dollar backed by gold, and we were the only one doing it, all the other currencies in the world would essentially be worthless. Nobody would want anything other than dollars, which would be extremely deflationary because the other currencies would not be desirable, and it would repeat the blunder Winston Churchill made in 1925. So I want to look at what, with those criteria, look at actually where the gold is. If you take the 17 members of the European monetary system, those who back the euro, they have 10,000 tons. The United States has 8,000 tons. tons. The IMF has about 3,000 tons. You see China,
Switzerland, it kind of tails off after that.
So the good news for the U.S. and Europe is we still have all the gold, and I think we will have the largest voice by far if there is a new International Monetary Conference, with one footnote, which is China is non-transparent, so that China bar at 1,000 tons is probably closer to 4,000 tons. We'll probably learn that a year from now when they update their figures. So China has bought themselves a very big seat at the table. So the first one, global money, global M1, 40% backing, that's about $7,000 an ounce. In other words, that's what the price of gold would have to be to support the money supply without deflation. So it's the non-deflationary implied price of gold. Global money supply, global M2 with 100% backing is $44,000 an ounce. The last scenario is collapse, which I actually think is the most likely, through a combination of wishful thinking, denial, delay, misapprehension of the statistical properties of risk, and bad policy. Will probably just blunder into a collapse, at which point the response would take the form of executive orders, and if there's social unrest, probably some kind of neo-fascism. The way to understand it, we have inflation and deflation going on at the same time, two opposite ideas happening at the same time. The deflation is natural. It's what happens in a depression because of deleveraging. So what's deleveraging? Well, I have to sell assets to pay off debt. When I sell assets, it tends to depress the price. I pay off the debt, but prices are going down, so now I have to sell more assets to pay off more debt, etc. And you get into a debt deflation cycle until you've liquidated everything and prices hit bottom and kind of people start looking around for bargains again, and the cycle starts to turn. But it can go a very long way, and Irving Fisher wrote about this in the 1920s in the debt deflation cycle theory of the Great Depression. But opposing that, we have inflation coming from policy. What's actually going on is we have sort of a notional 5% deflation and a notional 5% inflation, the deflation from deleveraging, the inflation from policy, and they're pushing against each other, and they're canceling each other out. But it's not stable. You've got these two forces, and one of them is going to prevail. That's going to snap, and it could snap either way. It could go into much more rapid inflation or much more serious deflation. Kind of the monetary policy roots of this. Here's the basic statement of the quantity theory of money. You all learned this in your first week of macroeconomics, but the equation is MV equals PQ. M is your money supply. V is the velocity. Velocity is just the turnover of money. So, I go to the bar tonight and I leave a tip, and the bartender takes the tip and takes a taxi home, and the taxi driver takes the fare and puts gasoline in his car. That dollar has velocity of 3 because $1 supported $3 of goods and services, the tip, the taxi, and the gasoline. But if I stay home and don't spend any money, my money has velocity of 0. So, and I remind people, $3 trillion times 0 is 0. In other words, if you don't have velocity, you don't have an economy. So basically, money supply, how much money is there, times velocity, how quickly is it turning over, equals the nominal GDP, the gross dollar value of all the goods and services in the economy. And nominal GDP has two parts. Q is the real part, and P is the price index, so inflation or deflation. But this is psychological. They have to basically lie to you. They have to engage in propaganda to bend the velocity curve to make you want to spend more money than you're actually doing right now so that they can get the nominal growth they need to pay off the debt. So how do you bend the velocity curve? What is the policy here? And as I mentioned, it's an exercise in propaganda. Two ways to do it, two tools, that is. The first is negative real rates. Negative real rates is when inflation is higher than the nominal rate. That's good because if you're a borrower in that world, you actually pay the bank back in cheaper dollars. That's better than zero interest. That's the bank paying you to be a borrower. So ideally, the Fed would say, well, 2%
on the 10-year note and 3% inflation, negative real rates of 1%.
That's a very powerful inducement to go out and borrow. The other thing they want to do is deliver an inflationary shock. If I promise you 2% and I deliver 2%, there's no change in behavior. I've exactly met your expectations, so there's no reason for you to change your behavior. What I have to do is lie to you. I have to tell you 2% and deliver 3%. That's a shock. Now you're like, oh, gee, inflation's out of control. Better go buy a house, buy a car, buy a refrigerator, do whatever. So that changes behavior. So 3% inflation with 2% or 2.5% on the 10-year note is a negative interest rate, which is a powerful inducement to borrow. And it's also an inflation shock, which is a powerful inducement to spend. And the idea of 3% inflation is to get the borrowing and the lending and spending machine going again, try to get nominal GDP back to trend, make it self-sustaining, withdraw policy, substitute real GDP for nominal GDP, get real GDP back to trend, and we all live happily ever after. This is what the Fed is trying to do. They're going to fail, but it's important to understand what they're trying to do, why they're trying to do it. Then when you see them failing, it's very easy to forecast monetary policy because they're just going to do more of it until they get what they want. Why do they have to get this? Well, why do they have to have inflation? What's wrong with a little deflation? Well, here's what's wrong with it. This is actually the Fed's worst nightmare. The government, in economic theory, inflation and deflation, prices are going up, prices are going down. So what? You get a raise or you don't get a raise, or you get a little benefit, or they're winners and losers. It would seem like a normal economic process. But the government's view of inflation, deflation is asymmetric. They have to have inflation. They cannot have deflation. They can't tax it. So imagine you make $100,000 a year, and your boss gives you a $10,000 raise and prices are constant. Okay, so you just had a $10,000 increase in your real standard of living. You got $10,000 more and prices are the same. Except what happens? Well, the government comes along and takes half. They take $5,000 and you get the other $5,000. But imagine an opposite case. You're making $100,000 a year. You don't get a raise, but prices drop 10%. Well, you had the same $10,000 increase in your standard of living. Your salary didn't go up at all, but the price of everything you buy went down, so you're better off. Except that now you get to keep the whole $10,000 because the government doesn't know how to tax deflation. So deflation can increase the real standard of living of the American people, but the government won't allow it because they can't tax it. It destroys tax revenues.